All right, great. Well, I'll go ahead and get started here. So again, my name is Alex Oliver. I'm a financial advisor with First National Corporation, and this is our fourth installment of our webinar series, our financial bootcamp series that we do with Schwartz and Schwartz accountants. Always a pleasure to have them put this on for us. And today our presentation is titled How to Fire Part 2. FIRE is financial independence and retiring early. And today we're going to be talking about distribution strategies for an early retiree. We did part 1 on the sort of FIRE series in the fall. That was talking about the accumulation stage of accumulating assets and getting ready for retirement. This is going to be relevant not only for the person that might be retiring early, but really anybody that's getting ready for retirement. I'm excited to put this webinar on today because this is really in the wheelhouse of what I do for my clients that I work with. If they're typically, within the 5 or 10 years of retirement, that's when they're starting to reach out to a financial advisor and really make sure they got their ducks in a row as far as making sure they have enough assets, they're positioned correctly. There's a lot that goes into these kinds of conversations, from investments to taxes to estate planning to insurance. And so I think I'm going to give you a little bit of a glimpse of those things. These decisions are important for anybody getting ready for retirement, but they're really magnified for those people who are trying to retire quote unquote early. And I would define that as, 40, 45 or 50 years old. Hard to believe, but there are people out there that, are able to retire that early. But when we're thinking about those assets lasting for 40 or 50 years without a full-time income, it's really important that we get these decisions and all of the consequences of those decisions really outlined to a T. So I'm going to give you a glimpse into what I do there and just some things that you'll want to think about. I'll take you through a sample client through my financial planning software that I use. And then again, just a lot of other little notes that you may want to consider as you're approaching your own retirement. Okay. So as we jump in here, just a little introduction on my firm very quickly. First National Corporation. We're located on the South Shore in Massachusetts in Rockland. We are what's called a registered investment advisor. So we're a completely independent company. When we work on the wealth management side, managing personal assets, we custody at Schwab or Fidelity, but again, no affiliation with those two companies. We have a 401k, 403b practice where we might custody assets at TIAA or MassMutual or John Hancock or whatnot. So again, the point being here that we're just a completely independent company hired to be a fiduciary for our clients. Fiduciary being a legal term, meaning that we have to act in the best interest of our clients with no conflicts of interest. So the only people that pay us to do the work is our clients. We don't get commissions or anything along those lines, okay? As I've mentioned, we've been doing several series with Schwartz and Schwartz. We've had a long-standing relationship with Schwartz and Schwartz accountants, going back, I think, roughly 15 years now. And so every year we've been putting on this series to give an array of topics because, as you can imagine, the income tax planning really fits into the financial plan and investments as a whole. And so here's a list of all the different webinars that I've been putting on. We've about last month went over for small business owners, simple IRAs, 401ks, profit sharing plans, and cash balance plans. So if you're wondering about those and you're a small business owner, that might be a good one to watch. I think it was February, we did health savings accounts, which has really become a popular account to use, not just for medical expenses, but for retirement planning as well. I did an overview of the stock market. This is a funny one to watch because it happened in January, and obviously a lot has happened since then. So that one might not be a good one to watch. And then, as I mentioned, we did another one on FIRE last fall, strategies to accumulate assets. But there's a lot of different topics here. I would definitely encourage you to go to schwartzaccountants.com/events/bootcamp. If you ever want to watch any of those, they're all on YouTube, so they're very easy to watch. I'd encourage you to watch them at 1.5 speed so you can really speed through them. And one more webinar I'll just bring you to your attention. Obviously, we're in the midst of COVID-19 at the moment. And a couple of weeks ago, we did a webinar at First National Corporation to talk about our outlook on what's happening with the markets. I also spend a good 20 to 30 minutes going over the CARES Act, and I break that up into what's relevant for individuals versus small business owners, whether it's unemployment, stimulus checks, or on the small business side, PPP loans, EIDLs, things of that nature. So that might be useful for you. Obviously, a lot has happened in the last couple of weeks, though, so just keep that in mind. that would be found at fncadvisor.com/webinars. Okay, so as we move into here, as always, I have to make sure I give you a little disclosure to make sure you consult your advisor before making any decisions. Don't look at anything I talk about today as general advice. Every situation is different. You're going to know that as soon as you see my presentation today, because there's an array of different assets that you may have accumulated in your life that just will not be relevant to a lot of other financial plans. So please make sure that you discuss with your financial advisor before implementing anything. So to start, and again, I'm going to follow our sample client with a bunch of tips and advice, but I do want to make sure I bring you through a financial planning sample and a software outlook as to how I end up constructing a financial plan, because I think when clients that maybe want to do this themselves, for example, maybe they've had their accounts at Vanguard, holding ETFs and whatnot, they are not exactly exposed to all of the different situations that may come up. And as I mentioned before, when I start to look at a client's situation and really give them the go-ahead to say, you're okay to retire now, I really want to make sure I'm looking at a lot of different scenarios, worst case scenarios, being very conservative with my assumptions. And so I want to bring you through how I might think about that, and again, bring that through the software and show you how that works. We're going to talk about Jeremy and Lori. They're 45 years old and they're getting ready to retire. So obviously some big decisions here. They've got one son who's currently married. So this will come into play as far as estate planning decisions go. We're going to consider several scenarios. We're going to go through what's called a Monte Carlo analysis in here in a second. Monte Carlo, just so you know, is something that takes a financial plan, however we draw it up, and essentially runs it through 1,000 trials, simulations, based on stock market history. So for example, what would it look like if you retired with this amount of assets right before the Great Depression started, okay? And obviously the Great Depression means that your stocks go way down, take a long time to recover. Anybody that retired in the last 3 or 4 months is actually probably feeling that right now as they went through COVID-19 and saw that big drop last month. This is going to help to outline those scenarios to say, you know, are you actually going to have a plan that sustains even those worst case scenarios? So we'll bring you through that. I'm going to go through the different sources of income because, again, this is a presentation about distribution strategies. So do I pull it from my IRA or my Roth IRA, or do I rely on my rental income or my pension? How do these all tie in together? And again, we'll go into more detail there within the cash flow report. So let me get my sample client brought up for you. So this is what I'm going to refer to as our wealth management system. This is a software that, very expensive for us to purchase, but is very valuable for us making our decisions. If anybody has ever used mint.com, where you've linked accounts to a certain website, they're just basically making links with the Bank of America or the Empower Retirement 401k plan. That's essentially how this works. The assets that we manage for our clients at Schwab Fidelity, I'm connecting here. So we have a live financial plan on a daily basis. And then obviously there are other accounts that our clients will connect, like a Bank of America checking account or what have you, where we're not managing them, but we want to at least be aware of what's happening there. And so as we create the financial plan, I'll then go in and enter some of the more manual details. So again, Jeremy and Lori here, age 45. The retirement age is also 45. We're going to have them live to age 100. Again, really make sure that we have enough assets to sustain a 55-year retirement. As I mentioned, their son Jay and Jay's wife Emily is entered into the picture here. Just to give you a glance as to what I'm going to be working with in this sample client, here's a list of all of their accounts. As you can imagine, a lot of the regular sort of things, checking accounts, brokerage accounts, 401ks. Jeremy does have a deferred comp plan. He's got restricted shares that we're going to be selling here in the first couple of years. They've got their primary residence, and they've got a rental property along with a mortgage with that rental property. We've also got a few different sources of income that I want to consider. We've got Social Security, which if you look at these numbers might seem kind of low for somebody that has accumulated these amount of assets. I'm going to get to that later because, again, they're not working from 45 years and older. So that's going to really hurt their Social Security income, but we've got to acknowledge it. Lori does have a pension that's going to start at age 65, so that'll come into play. We've got expenses here. We've estimated their current living expenses to, again, make sure that we're withdrawing a correct amount from their accounts, currently at $195,000. We've got the mortgage in here, which I can tell you has about 18 years left on it. And then we've got all sorts of different insurance. Those costs are assumed, state taxes or state of Massachusetts, and all of that's going to be kind of embedded in the background. Typically, if I was talking to a client, if they were pre-retirement, we would enter in all of their savings here, like Jeremy's 401k and the match that they get. But obviously, they're, again, retiring right now, so that's not going to be relevant for today's presentation, okay? So just for now, just understand that we've got some basic information here, and I just want to show you where I live as a financial advisor and where I spend most of my time really talking out these sort of scenarios. And I think you'll find this sort of interesting. So when we get a first glance at their overall retirement plan, we're going to find that it just doesn't work, okay? I'm going to click view in present value right here. Right now we're showing future dollars, so that accounts for inflation. But we want to just get into today's dollars so we can really get a better hold of what's happening. And you can see after they retire, after they sell their stocks, they're going to be withdrawing assets at a quite a substantial rate. This rate starts to slow down a little bit once their pension and Social Security kicks in. But at the end of the day, you can see that they're going to actually run out of money at age 82. Okay. Again, they're still going to have their Social Security and their pension, and I'll show you that right now, just to show you how this software really outlines that. As they get older, they'll again have the Social Security and pension still coming to them, but this line, this red line right here, keep in mind they need $195,000 of expenses in today's dollars, but they're just not going to cut it. They're going to run out of assets eventually by withdrawing their money, and they're going to have quite a gap here. So this actually puts them in a failing position. And so once we've got all that data in here, and I'll show you the details behind it, very briefly, I'll do that right now actually, just so you can see it. But this system on the fly is going to help me to see year by year all the different numbers going in and out of these accounts. So again, you can just see, if you really wanted to dive into the detail, you could see what's happening on a year by year basis. You can see that on the right hand side, these assets are just being withdrawn and ravaged as they get into the retirement, and again, slowly running out of money. Okay, so that lays us our sort of basic plan with our base facts. But what I spend a lot of time doing with my clients is going through a lot of different kinds of scenarios here. I'm just going to click modify and just show you these scenarios. In the green, we've got scenarios where we add assets, or maybe it helps our financial plan by selling property, for example, selling a business, or maybe we're going to have some income down the road. We've got the red category, which is going to take away from our financial plan. Obviously, if we gift to a charity or gift to a person, that's money coming out of our estate and no longer able to supply us for retirement. And then we've got blue scenarios, which could go up or down. So we could change growth rates, we could move retirement up or back, we could increase or decrease the living expenses. I think you get the idea. But the idea here is that I've built out a few different scenarios. Just want to show you a little bit about how this works. And we're going to get to distribution strategies in a minute, but I want to show you exactly how this sort of plays out. What I'll start to do when I sit down with a client is to outline some of these scenarios that they want to talk about with their plan. And so you may remember the very easy one that we can work with right now is lowering their yearly expenses. You may remember it was $195,000 before. So we could run a scenario very quickly to say, well, what if we decrease that to $160,000, and does the plan work? And if you were still watching, you could see that where we were in the blue, the plan that didn't work, we've now got a green bar because, again, obviously we're not taking out as much in assets. And so we've got assets left in the accounts that can continue to grow. And it's actually saying that from a linear perspective, we look like we're going to be okay. At the end of the plan, in today's dollars, we're going to be at $3.1 million in assets. So the emphasis here is that at least we have a place somewhere to start. But what I then want to make sure I really acknowledge here is that we really should be running this through a Monte Carlo analysis. Getting back to that fact that, these assets aren't just going to grow at 5% per year every year. There are going to be years that hopefully it goes up 10%, but there are definitely going to be years where the portfolio goes down 10%. That's a very important part of my job, is making an investment election to sustain, keep the standard deviation of those returns relatively low. But again, the Monte Carlo analysis will run this through to say, based on 1,000 different market simulations, would this plan be successful? And in this case, just based on the facts that I've put, it's giving it a 44% chance of success. And so that's not good. You can see that anywhere 0 to 69% is going to be in the red and definitely not okay. For a pre-retiree, if we're in the 82 to 100% range, we'll be okay with that, especially if they're 65 or 70 years old, because in all reality, if there was a downturn in the market, we could reduce expenses probably by 10 or 20 grand, and we could find ways to get around that. So we want to at least be in this range. But for somebody who's retiring at 45, we got to be at 99 or 100% to make sure we're okay with leaving the workforce at this time. So I'll just stay here for a second, because you can see if I just change this to $145,000, we're going to get a whole bunch of different additions into the plan. Once again, let's just see how that changes our Monte Carlo analysis. Now we're up to 71%. So we're in a pretty good place. So the idea here being that we can throw on a lot of different scenarios to get us at least first with the basic financial plan. So maybe Jeremy is actually going to work part-time for 10 years. In this case, I think I have him at $50,000. Yeah, $50,000 per year just going to their joint checking account. Let's get them back up to $160,000. That's, again, obviously going to get them in a good position with some income coming in. They could downsize their house in 20 years and net $400,000. We could plan on Social Security being reduced by 50% if we'd like, again, being conservative here. So if Social Security is going to change and we're relying on that for our bucket of income from ages 70 and on, we want to make sure that, again, we're accounting for any changes in that scenario. They may have a plan to gift $20,000 per year for 10 years to grandchildren, as an example, to set them up for college. So we're going to want to put that in there. Tax brackets. In 2026, we'll probably have an increase in tax brackets just due to the amount of stimulus that we are spending today during the COVID-19 times, and the fact that the Tax Cut and Jobs Act from 2017 expires during that time. So I think it's very feasible. Almost all of my financial plans are going to at least budget tax rates increasing in the future, so that will hurt the plan. We could consider selling the rental property. Now, let me just show you what that does, because you may remember that we had $36,000 worth of income. So let me get back to that withdrawal strategy for a moment and just show you that. The rental income is obviously tied to the rental property. So if we're going to sell that property, on the one hand, we're going to get a lot of liquidity there. So instead of running out of assets, this scenario right here assumes that we can't tap that asset. It's just going to be spinning off the $36,000 of income. Over here, we're still talking about a pension as well. Here, it's just the rental income. If I go ahead and sell that rental property, that rental income will go away once we get our calculations going. Sometimes it takes a minute. There we go. So we have that rental property being sold right here in 2037. The rental income is gone, and now we've got to make further withdrawals. So that could help or hurt the plan just based on how much rental income we actually have. And then finally, a very common scenario for me is long-term care expense. Typically, in a scenario like this, the husband might be the first one that we budget with a home health aid, the wife with a nursing home stay down the line. But that's a major expense that we want to make sure that we account for, okay? So again, before we even talk about distribution strategies, we want to make sure that we get a basic financial plan in place. We know what are the required withdrawals on a yearly basis. What is the timing of those withdrawals? And as we're starting to manipulate tax rates, which we're going to get into as this presentation goes along here, this really drives all of that. So I just want to make sure I emphasize the importance of creating that high-level financial plan. So now the last thing I'll show you within this software that really helps us to at least get a starting point with that withdrawal strategy. This, again, very complicated software, which is going through the different tax brackets and the different scenarios based on what I've told it. And it will actually start to make recommendations year by year on where those withdrawals are going to come from. So this graph does a great job. Again, obviously this financial plan that we've written does not work, but it's going to tell us what assets we're going to take from on a yearly basis. Those first few years, we have a lot of options. Right now we're looking at the deferred comp plan to a certain degree. We've got the brokerage funds to a certain degree. We've got Lori's IRA to a certain degree. When we get to about 2035, those accounts start to get drained and we don't have too many more options. So now we're relying on Jeremy's 401k. And then the last one on this list is going to be Lori's Roth IRA. And the Roth IRA typically comes last. We'll get to a lot of why that is as this presentation goes along. but it typically comes back last because it's a very valuable account. The money in there can grow tax-free, and if you're going to leave it to an heir, it's probably the best account that they could receive because they don't have to pay taxes on that money, unlike what they would have to do with a pre-tax account. Again, while they're working, that's not going to be a fun thing for them to do. So usually the Roth IRA is going to come into play at the end of the financial plan. However, there's a little bit of an art and science to creating this financial plan, because if we have the opinion that tax rates might be going up in the future, we might want to actually stagger this to some degree and say, well, maybe we don't want to take all these 401k contributions out during these years. Maybe these are going to be our highest tax year amounts. And you can see these withdrawals are getting up to 350 or 400,000. Maybe we actually want to layer some of this Roth IRA right here, cut it off at 250 and spread that out. That just is, again, a little bit dependent on the financial advisor you have. But I think just by really going through that very quickly, giving you a snapshot as to how this looks will give you an idea. Again, this is a financial plan that'll fail because we can see the withdrawals are well above what would be recommended. So they're certainly going to run out of money eventually with this kind of a plan. So we need to find a way to stretch those dollars, okay? So that gives you an idea of the sort of software side of things. Let's start to get into, again, maybe the art and science of this as to how we might be able to stretch those a little bit farther. And what I want to make sure I first acknowledge before creating any financial plan is that we should start to think about the withdrawal strategy in buckets to some degree. And for this couple, they're 45 years old. You could really simply look at it as ages 45 to ages 59 and a half. That might be one set of buckets, because 59 and a half is where the 10% penalty for withdrawals goes away. So that might be one bucket. Bucket number two, 59 and a half to age 70. And bucket number three would be 70 and beyond, because for any client of mine, we're going to say that we want to delay taking Social Security until age 70. The reason for that, as I'm sure you're already aware, is that you get a guaranteed increase of 8% per year from your Social Security benefit. And an 8% increase on essentially an annuity for you is much higher than what I could promise you from an investment portfolio that we manage. And especially with interest rates just being so low, it's very hard to get a very dependable source of income for a retiree. So in almost every plan, we're going to want to delay Social Security. Now, how much is that Social Security going to actually end up being? Well, this just kind of gives you an idea in 2020 what the maximums would end up being. So let's go ahead and stick with this age 70 number. If you had earned over the Social Security wage base for 35 years, and in 2020 that was defined as 137,700, in 2019 it was 132,900. So to some degree it goes with inflation, but you would just have to kind of take a look at your statement and see where you lie. But if you did that for 35 years, you would get $45,000 per year in Social Security if you waited. Now, if you and a spouse both did that, you're both doctors, you both paid over that amount, that's $90,000 of income. If you tell me that you're going to be able to live off $70,000 or $80,000 per year through your retirement, you're in great shape. Now we just need to worry about all your other assets getting you to age 70, with obviously some buffer zone for long-term care expenses or any other unforeseen circumstances, but you're in pretty good shape. The thing that I want to make sure I emphasize before we go too far here, though, is that for somebody who's retiring early, they really need to take a hard look at what that Social Security amount is going to be. It's a very valuable part of your income. And since it's calculated on 35 years worth of income, understand that when you look at your Social Security statement, it's going to assume that you're going to work at the same wage that you currently are through age 67. So if you're actually retiring early, you need to actually do a little bit of manual work here, because whatever these benefits are that the statement says you're going to have are just not accurate. It's assuming you're going to work and you're no longer going to work. So I've certainly had to do this. I just most recently had to do this with a 58-year-old client who's now retired, and manually ran the calculations, and her Social Security income dropped by about $5,000 per year. Okay, so that's fine. Her financial plan is okay, but it would be really tough to not know that and then we'll go make a claim at age 70 and get $5,000 less per year than you were actually thinking about. So make sure you take a look at that to, again, make sure that that side of the equation is taken care of, okay? Now, again, before we go too far into the tax side of things, we also need to make sure that we have an understanding as to how the assets need to be managed and withdrawn from in order to sustain such a long retirement arc. If you are here for part one of my FIRE presentation, you've seen this chart already, but I want to make sure I bring it up again, because for somebody who's retiring early and wants their assets to sustain, typically we're telling them that if they retire at age 65 and can stick to a 4% or 3.5% withdrawal rate, they should be able to have an amount of assets that provides them an income and stays almost flat throughout their retirement lifestyle. Obviously, there'll be up and down years, but a lot of empirical studies basically show that through the history of market returns, these withdrawal rates, 4% right here with these types of portfolios, this is 0%. The equities are in gray here. So we have 100% stocks, 0% bonds, and then we've got 0 stocks and 100% bonds. What is the likelihood that this portfolio would actually last over time? And so the 4% number usually gets us by, and as I mentioned before, if you had to raise that by 1 or 2% later because of tough market considerations, it wouldn't be the end of the world. The big point here being that if you're retiring at age 45 or an age earlier than 65, that might not be a prudent number to work with. 4% may not work. You may need to be looking at 3 or even 2% withdrawal rates to really ensure that you're not going to run out of money. Just so we understand what that means, if you needed $100,000 of annual income at a 2% withdrawal rate, you need about $5 million of liquid assets to draw from. Now, obviously, that's not including any rental income or pensions that you may need, but we're talking about a lot of money here. So make sure you have that figured out, because we'll also then start to think about which assets we're going to withdraw, and that might mean the assets that we withdraw in 5 or 10 years are going to be much more conservatively invested than the investments that we're going to withdraw from 10 to 20 years from now. So that's why, again, I started with the financial plan, and I start with this withdrawal set because that's going to outline what we do on an account-by-account basis. Okay. So let's start to talk about this from a tax perspective, because I think, especially if you're working with Schwartz and Schwartz, this is sort of what's on your mind here. This is just giving you a little bit of a history of the marginal tax rates in the United States. We try to make as many decisions as we can in an educated manner based on today's circumstances, but we have to acknowledge that these things change. Luckily, on the lower end, there aren't as many changes as there are on the higher end, okay? So, you know, this goes back to 1910 all the way through 2018. You see that little dip there with the TCJA in 2017. This marginal tax rate at the top end has really changed over the course of the history of the United States, but the lower end is actually relatively consistent. Again, I would encourage anticipating an increase in the taxes. You can see it has been higher than it is currently today, but it shouldn't make a massive difference in the overall financial plan. So in the financial plan I had earlier, I had it budgeted at 5%. I think that would be a prudent number to use, okay? Now, keeping in mind, through your working life, you have hopefully been encouraged to make pre-tax elections. And this sort of gives you the sort of bucket list of where you would be going to accumulate assets. Always getting your 401k match first, paying off high interest debt, maxing out the health savings account, which I have a whole webinar on, as I mentioned. So check that out if you don't know what that is. Maxing out your 401k, then doing backdoor Roths, then doing a taxable account, and then paying off low interest debt. So what does that mean? It means you're going to have a lot of different accounts with a lot of different tax consequences. And the whole purpose behind that bucket list was to basically do what I'm showing you here. When you were making money, you were encouraged, if you were a business owner, to put away upwards of $56,000, $57,000, or $63,000 if you're over the age of 50 into your retirement plans, or if you're a small business owner, maybe even a cash balance plan, because all of that was avoiding you paying taxes at these highest brackets, okay, which, you know, depending on if you were single or married, we're talking about a married couple here, so that you might be avoiding assets at a 35% bracket to later, during retirement, withdrawing those assets in these much lower buckets. So the way the tax system works is that we all get a standard deduction. The married couple is a little over $24,000. So that first $24,000 withdrawal from a pre-tax account is taxed at 0%, as opposed to the 35% that you avoided earlier. And then the next little bucket is 10%. The next bucket is 12%. So essentially, you can withdraw $100,000. The effective tax rate of that withdrawal is going to fall somewhere around 8 or 9%. So you're paying a much lower rate of tax on an income tax perspective than you were during your working years. But we want to balance that. So we don't want to just take all of our money from the pre-tax 401k, because if we take all of our contributions out from that one account, we might start rising up in brackets, and it may not be as efficient as opposed to if we layered on brokerage accounts, Roth IRAs, things of that nature, okay? So this sort of demographic here is supposed to really make sure we outline just keeping a little bit of a balance and pulling our income sources from various different places, okay? And that's obviously going to change as tax rates change over time. So let me just briefly go through this list, because these are all types of different assets that you may have accumulated in your working life. Some you have, some you don't, and there's probably even some missing from this list. So you know, a married couple, for example, they might have 2 different IRAs. These are pre-tax accounts. You take the money out, you have to pay income tax on that. You might have 2 Roth IRAs. This is the opposite. You already paid taxes on this money. When you take it out, you don't owe any more taxes. The joint investment account. This is after-tax money that grew. When you withdraw this money, you now have to pay capital gains taxes on any of that growth, which is likely going to be 15%, but could be 0% based on your situation and your income. So that's a consideration. Health savings account. This one's a little more complicated because this is, again, a pre-tax account, a lot like an IRA, but a lot of people use a health savings account to stack up their medical expenses and not make withdrawals. So you actually might have a HSA that has $200,000 in it, but $50,000 of it might be after-tax money that you can withdraw today without any taxes or penalties. So again, if you don't know much about HSAs, I'd just go on ahead and watch those webinars. Annuities. This is even more complicated because you might have an immediate annuity or a deferred annuity. It could be a qualified annuity or a non-qualified annuity. And this is just basically talking about whether it's retirement money or not. So the tax implication of those withdrawals also has to be considered as you're laying on your withdrawal strategy. If you've got a pension coming in down the line, that's going to be part of this. If you've got deferred compensation, depending on your employer, you may need to take that all out within 1 year of retiring. You may be able to make an annuity out of that. That's going to be certainly a consideration. Your primary residence might be part of your retirement portfolio if you expect to downsize at some point. Maybe you've got 4 bedrooms from when you had your children here, but if you're going to downsize, there could be a tax consequence there if the gain on that house exceeds your exclusion amount. So that the timing of that may be something we want to think about. Rental property, we've talked about a little bit today. Rental income, rental property we may have depreciated. So if we sell that, that could be an issue. Rental income is part of the ordinary income that we're going to have. It's earned income. Vacation properties, again, tax issues for selling those potentially. You may have part-time work. And if you're planning on doing that, we want to spread out some of those pre-tax withdrawals to a time when you won't have part-time work. Whole life insurance, if you've heard some of my past webinars, I'm likely going to tell you that you probably don't want this, but if you have it and the surrender fees are too high, are we going to use some of that cash value as part of a withdrawal strategy where we don't owe taxes on that? How does that play into things? And then restricted stock or any other stock options obviously has some big considerations. Okay, so let's take a step back too, because I hope that the people attending this webinar are in a fortunate position to have enough assets to provide them with a good income. But this still is important to consider from a high level when it comes to estate planning. Which assets do I want to withdraw for myself? Which ones am I going to give to my heirs? And which ones am I going to give to charity, for an example? Because if you do have thoughts on that, let's say I want to leave my children with $500,000 or $1 million, or if I want to leave $1 million to charity, there are accounts that you want to do that with and accounts that you don't want to do that with. So we want to make sure we, again, outline the financial plan first so we can make the most efficient transfer possible. So which type of assets you might want to leave to them? Let's just talk about, for example, leaving money to your heirs. So do I want to leave pre or post-tax money? I'll bring up the Secure Act here. The Secure Act was signed into law in December, which feels like a really long time ago now. But this really changed a lot in regards to retirement plan withdrawals, because in the past, if let's just say I'm a 30-year-old and I inherit my father's IRA, I could stretch out the withdrawals of that IRA over my lifetime. So those withdrawals, those required minimum distributions, could be relatively low and not have a huge tax impact on me. Well, under the Secure Act, I now have to make those withdrawals over a period of 10 years. And so since most people's children are going to still be working by the time they inherit that money, they're also going to be in their highest tax brackets themselves. So if they're a surgeon and they're making over $500,000 a year and they have to now inherit your IRA, the whole point of the IRA was to avoid income taxes. And now they're going to have to pay it at the highest rate that is in existence. So you may actually want to withdraw from that IRA as a retiree when you're at a zero income, as opposed to leaving that to an heir that has to withdraw it over 10 years. So, typically we're going to want to have heirs that are still making money inherit those after-tax assets, whether that's a Roth IRA, whether that's a brokerage account that gets a step up in basis, those kinds of things, that would be part of our strategy. Rental properties, not so much a tax or consideration, but more of a lifestyle situation. Are your heirs going to want to inherit those properties and manage them? Are they set up to be managed? Or is that something that you'll actually want to dispose of while you're alive and just let your heirs inherit the after-tax assets? That might be something that you'll want to consider, okay? Some of the financial plans that I work with are really relying on this step-up in basis rule. So step-up in basis just basically means that if I have, in most cases, let's just say a property, a piece of real estate, a house or a rental property, and if I bought that for $100,000 and it's now worth $1 million, or if I've depreciated it to a certain point, etc., I now have a gain of $900,000. If I sell that property during my lifetime, I have to pay taxes on that gain. Whereas if I just leave that to my children when I pass away, they get a step up in basis. Basically, their cost on the books is $1 million. They can sell it tomorrow and earn and pay no taxes on that sale. But the step up in basis rule is certainly one that gets talked about whenever there's a new tax law. I could very easily see it being eliminated for sometime in the future. And for a couple that's 45 years old, looking at a long retirement, that would be a consideration we would really want to make sure we talk about. So is your financial plan relying on step-up in basis? That may mean not selling some rental properties, for example, okay? I mentioned the charitable giving plan. So if you're looking at your assets, and again, the couple we talked about before had $5 million set aside, if they just had a high-level thought as to, I want to push $1 million to charity somehow, some way, when am I going to do that? Am I going to start making those contributions today? Am I going to wait until later in my retirement life to ensure that I still have income? Am I going to do that during life when I can get a tax deduction for making those gifts? Or am I going to want to wait until the day I die or I don't get that deduction anymore? And so this is where I'll start to encourage my clients to start at least shifting some money to what's called a donor advised fund, which is where I can give money to basically a charitable trust, but not necessarily push it out to the charities yet if I'm not sure which charities I want to actually end up putting them into. I have a lot of clients do this within their last 5 years of retirement because their incomes are still very high. So they get their tax deductions now, but they distribute the charities over their retirement life. So that might be a very good strategy if charitable giving is part of your plan. And then finally, long-term care insurance. This is a big part. I put it into the estate planning aspects because, you may have this great plan as to which assets you want to leave to each individual. But if we've got clients that have had to be in nursing homes for 5, 6, 7 years, that's quite a cost. And that cost has to come from somewhere. And so if you're young enough to still be able to apply for long-term care insurance and you really care about these kinds of things and where your assets are going to go, it may be something worth taking a look at so that way you can at least have a set of control over how your retirement arc is going to look, okay? If not, we want to make sure we set aside some bucket of money, whether that's in an after-tax account or a pre-tax account, based on the plan, so we can account for those major withdrawals that are coming down the road, most likely. Okay, so I'm going to leave you with a couple of things here as we wrap up, just a couple more slides, just some really basic tips as to the order in which you may want to start making your withdrawals from, and a few different ideas for you. This is, again, certainly not a blanket recommendation because everybody's situation is very different. But in general, I would tell you that if you had no rental income and just nothing really complicated about your situation, you would probably want to, and I have just getting to age 59 and a half here, because again, we're talking about that 45-year-old, you would want to start tapping non-qualified deferred compensation or 457B plans. These are the kind of plans that do not have a 10% penalty for making withdrawals before age 59 and a half and would allow you to start hopefully staggering some of your income here, whether that some of this is after-tax money or some of this is pre-tax money, whether, again, you have to do it in a lump sum or over 5 years or make an annuity out of it. That's almost obviously going to be the first place you want to tackle, especially because, the deferred comp plans, are not really guaranteed money. They're really based on your company's solvency. So, a deferred comp plan from General Electric looked a lot better 10 years ago than it does today in 2020. So you're going to want to get your money out of there first. Then you're going to want to think about your taxable accounts. So the taxable accounts would be your brokerage accounts. It's not a retirement account or anything like that. You've been putting money in there. This is where if you sold everything, you would have to pay capital gains taxes. But this is where tax loss harvesting really comes into play. Maybe during your working years, you've sold positions that had a loss, so you could write off the $3,000 loss against your income tax. But now you're going to do this every year so that you can at least mitigate the gains that you have within your account. You should really be taking an active look at that. So that way, again, when you're taking withdrawals from the taxable account, you don't have a major tax bill on a year-to-year basis. So that's definitely step number 2. Then if we have to empty those buckets, you may want to consider what are called substantially equal periodic payments. It's essentially making an annuity out of your IRA. This is certainly something that I can't say I've ever recommended because I don't like losing that control. But if you've got 3 or 4 different retirement accounts and one of them can be annuitized for a small amount of money, it might be a way for you to avoid that 10% penalty and get some sort of income during your early retirement life. Then I might direct you to HSA assets, matching those with qualified expenses. So again, as I said before, you may have a $200,000 HSA, 50,000 of that you had incurred expenses medically, you had logged them, but you had not made the withdrawals yet. So you let the assets grow over those 10 or 20 years. Now you can start to take those assets out and you don't have to pay any taxes on that. And similar concept with Roth IRAs, any contributions you've made to a Roth IRA over the years, you don't have to pay taxes on it, and you don't pay a penalty for withdrawing those at age 59 and a half. So I would hate to tap this one if I could help it, because again, the Roth IRA is your most valuable account, but do know that out of your $300,000 Roth IRA, you probably have $100,000 worth of contributions, which were $5,000, $6,000 per year for however many years that you could withdraw to get you by for a few years and not have to face any penalties or taxes on. Okay, so that could definitely help you to get to 59 and a half, and hopefully you don't have to withdraw all your contributions. And then again, I say if you're stuck, you can start to tap the cash value of your whole life insurance. Hopefully you can look at disposing that altogether, because that's usually an inefficient way of creating a retirement income stream. So last idea for you, especially again, going back to the early retiree, if there's anybody here that is really genuinely thinking they're going to retire at a very early age, you may want to start thinking about early Roth conversions. So this is just a little rule that helps you to get access to capital at an early age. So a Roth conversion is basically raising your hand and taking part of your IRA. Let's just say you had $100,000 in your IRA. You might go ahead and take $10,000 of that and convert it to the Roth. You're raising your hand to the federal government and you're saying, I want to pay taxes on this today. And so as part of that conversion, you're going to pay it at your ordinary income tax rate. So I wouldn't necessarily do that if you're still working today, because again, the whole idea was to avoid these income taxes. But if you're in early retirement and you are at a low income base, you might start making these Roth conversions and start making what's called a 5-year ladder strategy. Because every time you make a Roth conversion, If you wait for 5 years, you can now convert that $10,000 and withdraw it without paying any taxes or penalties. Again, giving you access to funds before age 59 and a half, okay? So anybody that's retiring early, again, our couple was 45 years old. At age 46, that's definitely one of the topics I'm talking about with them, because we're gonna fill those tax buckets to whatever we think is realistic, certainly at least up to that 12% marginal tax bracket, maybe even going further to 22%. And we're outlining where exactly that money is gonna come from. The Roth conversions might be able to give you some access to those funds from ages 46 to 59 and a half, okay? So definitely a consideration. And for those people that have really accumulated a lot in pre-tax assets, the biggest thing that you have to worry about is that when you're 75, 80, 85 years old, from a tax perspective, you're going to have very high required minimum distributions. So the government forces you to take money out of your IRA so you can pay taxes on it today. And so the financial plans that I draw up have just incredible amounts of withdrawals. I mean, this starts out very low at 2.5%, but later in life gets to be 15 to 20% of the entire account value. So if you've got $1 million, you have to take $200,000 out. You have to pay income taxes on that whole amount. You're paying a lot at that point in time. So if we can start doing Roth conversions early in the retirement life cycle, we can really avoid what's coming down the road, which again is likely higher tax brackets in the future and high withdrawals that make us rise in those high marginal brackets, which again, if you remember my graph earlier, we're in a pretty low environment today as compared to where we were in the past. And with the amount of stimulus spending that's happening as part of COVID-19, I can almost guarantee that you'll see a time in the next 20 years where taxes are much higher than they are today. So just a major consideration there that Roth conversions may be a very big part of your retirement strategy. Okay, so hopefully I've given you a few ideas here. There was a lot to think about based on your set of accounts and the balance of that, but I think you get the general idea as far as distributions, making sure you have an outlined plan to get a very efficient withdrawal from your accounts and make these dollars stretch. These kinds of decisions really could add 5 or 10 years to your retirement life cycle just by making sure that we have an appropriate strategy in place based on your needs, whether you're going to do charity work or give to your heirs or how much you're going to spend in retirement. It really comes back to that financial plan, which is what I started the call off with today. Okay, so I appreciate you turning in today. Just to give you some more information on us, First National Corporation, you can go to our website, fncadvisor.com. We've got a lot of different information there, which goes into the personal wealth management that we do here for our clients, the institutional retirement plans that we manage here, around 60 or 70 of them across the greater Boston area, and then some of our investment strategies that we do place into our portfolio. So feel free to visit that. If you happen to be a dentist, we've got a tab for you here that you can click on and request an ebook for free. And you don't have to be a dentist to request this, but you've got some really good basic ideas around all of these topics. And today we're basically talking about investment and tax strategies for retirement withdrawals. So this is a short ebook, about 82 pages. It'll be a very quick read. And I end up sending that to you in a Kindle and a PDF version. So feel free to go to fncadvisor.com/dentist and request that and take a glance at some of the ideas that we have in there, okay? And then if you want my contact information, my name here, Alex Oliver. You can see our blog here for some content. Connect with me on LinkedIn, or feel free to shoot me an email, alex@fncadvisor.com. If you have any questions about today's webinar, any questions in general about your situation that you would like a little bit further consultation on, feel free to reach out and I'm happy to help. So thanks again, everybody, for joining our webinar. Hope everybody has a great day and a great weekend.